Hey, what's up, everybody? My name's Keena, and if you're new here, I talk about personal finance, investing, and business. Today, I'm going to break down the meeting that just happened at the Federal Reserve. So about every 6 weeks or so, the Federal Open Market Committee, or the FOMC, meets, and they chart the future of monetary policy in America. So the takeaway from this meeting is that they're not raising rates or doing any tapering. Now, if that sounds like gibberish to you, give me a second to explain. So raising rates refers to increasing the interest rate that the Federal Reserve charges when it lends money out, typically to other banks. So generally, when the economy is doing good, they'll increase that rate, and it's generally done to kind of keep inflation under control. And tapering refers to ending the policy of quantitative easing. That's a program that kind of injects money into the economy. The idea is that if you introduce new money into the system during a crisis, that added liquidity can kind of boost economic activity and really kickstart a positive cycle of growth and pull us out of a downturn. So both of those tools, the lowering of rates and the introduction of quantitative easing, was done right when the COVID pandemic hit at the beginning of last year. And now there's a lot of discussion about ending both of those things. So while they're not doing any of them right now, they are talking about the timelines for doing them. And the taper is likely to happen as soon as November, so like 6 weeks from now at their next meeting. Take a listen with me.
At our meeting that concluded earlier today, the committee continued to discuss the progress made toward our goals since the committee adopted its asset purchase guidance last December. Since then, the economy has made progress toward these goals.
Okay, hold on. This probably is confusing. So at the end of last year, the FOMC set two goals of the first one is maximum employment, and the second is price stability, meaning not a lot of inflation. So basically, what he's saying is when those goals are met, or specifically when substantial further progress towards the goals of maximum employment and price stability, when that happens, then the tapering will commence. Okay, let's keep going.
If progress continues broadly as expected, the committee judges that a moderation in the pace of asset purchases may soon be warranted.
Okay, moderation in the pace of asset purchases. There's a lot of confusing language here. Basically, slowing down quantitative easing to a stop. That's tapering, right? And so hold on, it's coming.
Once the committee decides that they've met, and that could come as soon as the next meeting, that's the purpose of that language, is to put notice out that could come as soon as the next meeting. The committee will consider that test, and we'll also look at the broader environment at that time and make a decision whether to taper.
Basically, the taper is coming. And when he's talking about the next meeting, well, that's 6 weeks from now on November 2nd and 3rd.
And it will put us, having completed our taper sometime around the middle of next year, which seems appropriate. The asset purchases, as I mentioned, were very, very important in the early stages of the crisis. They were essential in restoring market function in the Treasury and other markets. Then, as the recovery got going, they supported aggregate demand, as they will do. And now we're in a situation where they still have a use, but it's time for us to begin to taper them. Their usefulness is much less as a tool than it was at the very beginning.
Okay, so this is the first meeting where we've kind of gotten more firm timelines. So basically, November 2nd and 3rd, they're probably going to start tapering off quantitative easing, and that's going to last until June or July of next year. So that's 6-7 months timeline there. So the question is then, what does this mean for your investments? And generally speaking, when announcements are made like this, there's kind of some short-term fear. Actually, we saw earlier this week the markets pull back a little bit. When I took a glance back at 2013 and looking at Ben Bernanke, who was the chair at the time, his announcement of the taper then, again, there's a slight downtick, but really not a long-term issue. So I would say don't change anything about your investment approach, but maybe expect some market pullback as this begins and starts to happen. So let's talk about the other issue, which is raising rates. One questioner asked a very astute question, which was basically, would liftoff of the rate increase happen before or after the taper ends? So let me pull this clip.
Well, so again, substantial further progress toward our goals is the test for beginning the taper. And the taper takes some months in everyone's figuring. So you're going to be well away from satisfying the liftoff test when we begin the taper. So, in terms of the liftoff test, though, it's what we adopted last September. It's labor market conditions consistent with maximum employment, and while we have interesting signs that in many ways the labor market's very tight, we also have lots of slack in the labor market, and we think that those imbalances will sort themselves out. Inflation at 2% and on track to achieve moderately higher inflation over 2%. That really depends on the path of inflation. If inflation remains higher during the course of 2022, then we may already have met that test by the time we reach liftoff. So I just think if you look at what people are writing down for year-end 2022 numbers, some people are writing down very low unemployment rates, and that's only one indicator, but it suggests a very strong labor market. And I think they're writing down in good faith what they see as meeting the test. There's a range of perspectives about where the economy will be, but by the way, all but one participants have us lifting off during 2023. So it's not really an unusually wide array of views about this.
So a couple of things to take away from that. First of all, we're getting more timelines. Basically, many of the participants think that they're going to vote to raise rates in 2022, and he says right there at the end that all of them, except for one, think that they're going to vote to raise rates in 2023. So this is coming and sooner than we had thought previously. I think that raising of the Fed funds rate is going to have a larger impact on the stock market and the economy than tapering off quantitative easing. We'll kind of cross that bridge when we come to it. And then, of course, the other thing that he's throwing in here is just, all of these timelines are here, barring any unforeseen issues. So if another variant of the illness comes out or something like that, that might change things. So again, I think this is a really astute question. Let me pull up this summary of economic projections that they released. And we can see here that the Fed funds rate, they're projecting here that it'll increase from 0.1 to 0.3%. So I think that's kind of why he's asking this question. Like, are we going to finish the taper before the funds rate ticks up? The answer to that is yes. And then kind of what's the timeline for that? So we got answers to both of those questions there. I want to touch on a couple of other topics that came to light during the Q&A session after Jerome Powell's speech. The first is he was asked about African American and Hispanic unemployment rates, which are elevated above that of other races in this country. And I think he was asked this question because earlier in his speech, he talked about how unemployment goals were all but met in his view. Also, if I recall in past meetings earlier this year, he said that he'd wanted to keep policy accommodative, specifically to help minorities, who are more likely to be in service sector jobs, leisure, travel, hospitality, the kinds of roles that are really impacted by COVID. But this time around, he had a different response. So basically, he said he thinks fiscal policy and educational policy should be used to eliminate racial inequality, and that Congress would be a better branch of the government, so to speak, to deal with this. And you know what? I agree. The Fed has more broad and blunt tools, and this whole issue of inequality is just so much more nuanced. It's tough to just target certain areas or classes of people with the tools that they have. He was also asked a couple of questions about crypto or specifically central bank digital currency at the end of the Q&A session. And generally, he honestly seems really supportive. And he made it sound like he's leaning towards crypto kind of being considered a currency. Right now, there's this whole issue of is crypto a currency or is it a security? And if it's considered a security, there's more regulations, the SEC is more involved, there's more tax implications. So, anybody that's really involved in crypto wants it to be considered a currency. It seemed like he was implying that it was. It's hard to tell. He was also pressed on a timeline. One of the questioners was asking if we were falling behind, and he said on more than one occasion that it's better to be right, or it's better to do it right than do it fast. And you know what? I also agree with that. One other thing is he talked about implementing an instant settlement system. So, I'm probably as annoyed as everybody else is about having to wait a few days for my transfers to go through ACH and all of that. So I assume he's talking about something that would be used in place of SWIFT. Obviously this is what Ripple, the cryptocurrency, is doing. I don't know what this is going to look like, but it sounds like the Fed is undertaking their own project to speed up that whole process, which is interesting and probably pretty good. So that about wraps up the meeting today. No huge announcements really, but we did get a much more concrete timeline for when quantitative easing will end and when the Fed funds rate could be expected to increase today. So that was some new information. And then, as always, the Q&As get a little bit interesting. So, hey, thanks for tuning in. And if this is useful, smash that subscribe button. Thank you, and I'll see you in the next one.